Thanks
indeed.
Thank you.
Well, the market is holding on with about 135 odd point sort of pop. We're at about, what, 17,122. Holding on. So far, so good. Our next guest is someone who's seen global markets very closely for a long period of time. Dan Fineman is co-head of equity strategy, Asia Pacific at Credit Suisse, and he's joining us right now. Dan, great to have you with us here. Thank you very much for your time. You know, you are in more ways than one at the center of things in terms of being able to see what's going on around you. So tell us, are things thawing a little bit, or you know, the uncertainty in terms of what happens in terms of financial dislocation still remains very, very high? What's your sense?
Well, I think that any time you see as big a rise in interest rates as we've had over the past year, there's the potential for accidents to happen. I wouldn't, however, say that the current episode is going to lead to a systemic crisis. The banking jitters that we've seen so far are largely idiosyncratic. And more importantly, central banks and regulators have learned a lot since the global financial crisis in 2008. They know that you need to step in with large liquidity injections early, and that can prevent a crisis from appearing.
Dan, I'm tempted to ask what the conversations would be in the corridors of your own office, because you know, Credit Suisse also has been at the epicenter.
Well, as I say, we are confident that regulators and central banks have matters in hand. I think it's important to keep in mind that we don't have a credit quality issue in any of the banks that are facing pressures right now. There's a big difference between a situation where banks have big NPLs and where there are solvency questions, and what we've got right now, which is basically a liquidity problem. Central banks can deal with liquidity problems much more easily than they can deal with NPL and solvency issues.
Dan, you know, one argument that I heard over the last 48 hours or so, and it seems to be a very logical argument, that right now this is perhaps an asset liability mismatch issue that's playing out across different banks because of the space of, you know, interest rate hikes that we've seen. But quite a few commentators feel that perhaps a couple of months down the line, it could start becoming a credit quality issue as we get this hard landing or soft landing in the US, and in general, growth slows down around the world. That could be a very serious scenario, but do you see that playing out?
I don't think so. If you look at household leverage, it's quite a bit lower, particularly in the US, than it was on the eve of the global financial crisis in 2008. We're expecting a recession in the US, but not a deep recession. We think it'll be a fairly shallow, a fairly short-lived recession. It will likely be a recession that leads to earnings problems at banks, but not a systemic issue.
So what's the, okay, so in you know, given how things stand right now, what is the equity call for Asia Pacific, and specifically a market like India, which in any case, even before these global worries, you know, we were dealing with a lot of money moving out of here into our neighboring market, China?
Well, I think the call is that Asia is a better place to be than the US or Europe right now. We have more robust economies. Cyclically, the economies are better positioned. We don't have the same inflation problem. You haven't had the big run-up in rates and bond yields that are causing some stresses in Western financial systems right now. India is a place that I think looks quite safe right now. We're not entirely happy with the valuations, but the macroeconomic backdrop is quite stable.
So if you had to allocate some assets, you know, between, say, gold, debt, equity, and inequity, you have developed markets, emerging markets. In emerging markets, you have India, China. How would you, you know, distribute a fresh $100 check?
Well, we're roughly neutral between fixed income and equities as asset classes as a whole, but within equities, I think you can do better than fixed income in Asia and in emerging markets. We have a big overweight in global emerging markets within equities, and I think you can make money in absolute terms this year, which probably won't be the case for U.S. equities.
Mangalam, just to rephrase that question, you should have asked, if you had a $100 check, would you wait to put all of it in India, or would you put it in right away? I would have got
He's still with us. What are your thoughts?
Dan, are you there?
Yeah. Yes. So we would be roughly at benchmark in India.
Got it.
But within an Asian portfolio, within a global portfolio, we would be overweight.
All right, now got that. Okay, let's just pull back a little bit to global again. After market hours, we had some data which I think this is data from, with regards to borrowing from the Fed, which has topped about $160 billion over, this is weekly data from the Fed. Another data point which some are talking about is that inflows into money market funds in the US is basically at the highest level, again, the weekly data, at the highest level since April of 2020. How would you read both these? Clearly shows risk aversion. The question is, can you use this data to interpret what comes next in a positive or negative way? Go on.
Well, I think the positive angle is that it will probably avert a crisis. The negative angle for some players would be that for mid and small banks, that they're probably going to have to pay a deposit premium to be able to attract depositors to put money with their banks as opposed to the bigger banks that are perceived as being safer.
Dan, just to press that point on India slightly further, care to give us some more color into, as you do allocate more, if you do, what pockets would you target? And is valuation your prime criteria? You'd only look at pockets where you feel valuations are right? Or would you look at, let's say, safety, play the Indian consumer? How are you strategizing on this?
I certainly wouldn't be relying purely on valuations. I'd say the key issue is to focus on domestic India over international India, over exporters of goods or services. So banks, consumer, which are exposed to domestic India, those would be the places I would focus on.
All right, Dan, great to speak with you. Thank you very much for your time, and hope to speak with you again soon. Let's hope things settle down. I think in the best interest of everyone, the financial markets and, of course, the real economy as well. We'll take a very quick commercial break here. We've got the market, which has come off already. We're about 88 points higher. So I'll just quickly look at what the day's high is. The day's high stands at 17,145, which means now we're about 70-80 points off the high point of the day already. 0.5% on the Nifty still there. We'll come back and we'll speak with the management of Samvardhana Motherson International, who will talk to us about their selling of 3.5% stake by Sumitomo Wiring Systems. Later, we'll also connect with Kiran Mazumdar-Shaw of Biocon and Biocon